The S&P 500 looks to have opened very strong today, with semiconductors performing incredibly well. However, our focus today is going to be on 8 of the most undervalued dividend stocks with massive upside. We're going to run through some of these that we do believe deserve your attention, and also talk about our own valuation and the upside that we see in some of these. Now we're kicking things off with Qualcomm Incorporated, where it does have a double buy signal and a hold from Quant. Now it currently trades in the mid to lower end of the 52-week range. As we said, each one a dividend stock. This one currently yields around 2.09% with a forward P of around 16.2. For context, the S&P currently trades around 22.5 and it is up around 47% over the last year. Over the last 10 years, up 118%, and we can see here all-time highs not too long ago in June 2024 at around $230. Now we also want to very quickly, before jumping into the valuation, look at how well their earnings have been, as well as future projections. And nice to note, for the first one, Qualcomm, we are seeing a 100% track record over the last year in terms of beating analyst performance. And over the next 4 quarters, we are seeing some very strong numbers indicating a nice growth year on year. Now, if they do hit those EPS estimates of 2025, then their forward P will come down to around 14.5, making it even more attractive. Now, as we mentioned, for each one of these, we're going to run them through the valuation model. And today, the intrinsic value of Qualcomm is coming to $210. As always, when we do our in-depth dive on this channel, we run through every single one of these models. Today, we're looking at 8 different dividend stocks, so we will go through them very quickly. And as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. As we then said, intrinsic value $210, not too dissimilar from Wall Street of $211, where they see 26% upside, and we have started off the episode today with the stock with the least amount of upside, so it will be significantly higher as we go along. As always, we do use a 10% margin of safety, and we execute on that if it meets the 3 golden criteria: wide moat, strong financial metrics, good forward-looking data, and then we keep going till it's near the current trading price. And in today's episode, based on the current value for Qualcomm, you are getting a 20% MOS with 26% upside in terms of Wall Street and their expectations. As always, let us know your thoughts as we do go along these today. We also want to let you know we have released our latest free weekly article. If you want access to this or any others, all completely free, do click on that pinned comment below where you can sign up and read straight away. And we have also released our undervalued stocks for the month of August, and we also take a look at the ones that we do hold and do see as great opportunities moving forwards. The next stock we're looking at is Micron Technology, where in fact we get a strong buy from Wall Street, a buy from Seeking Alpha, and a hold from Quant. This one is trading in the mid to lower end of the 52-week range with a lower yield than Qualcomm of 0.5% and a very high forward P of 79. Over the last year, it is up around 43%. Over the last 10 years, outperformed the S&P, up 192%. Now, in terms of their earnings performance, they have actually also, similar to Qualcomm, had a 100% track record, so that does look very good. And if in fact they do hit the EPS estimate of 2025, the forward P will come down all the way to around 9.93, so that does make it incredibly more attractive. As we can in fact see for quarter 2 and quarter 3 of 2025, they are expecting some massive growth to the EPS on a year-on-year basis. Then in terms of the valuation, well, our intrinsic value of 138 is much lower than Wall Street. They have a price target of 169. As we mentioned, the upsides are very high today, 74%. Now, we will explain for MU how we did get to this price at 138. We did run it through the DCF model. As you can see here, the free cash flow year on year. We also have some massive growth rate over the last 10 years, slightly skewed in terms of the movement from negative to positive. And we have 3 different growth rates here, a low, medium, and high. Now, these are significantly lower than what management expects over the longer term, so we do believe these to be fairly conservative, and the 2024 figure here is the estimate of what they believe they will be able to achieve. Now, with the 15% growth rate and the discount rate of 8%, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and as we can see, that undervaluation signal, and that indicates upside around 43%. But as we can see here, Wall Street believe that is way too conservative. They see a massive amount at 74%. Now, in terms of our margin of safety, we're at 10%, a buy at 125. At the 20% level, a buy at 111. And in today's episode, it is pretty much right there at a 30% MOS. And as we can see here, Wall Street extremely bullish. As we mentioned at the beginning, they do see this as a strong buy. Now, don't forget you can always grab a copy of this model by clicking on the pinned comment below and running in your own numbers, whether it is for MU or any other companies. Moving on, we have ASML. We have a double buy and a hold from Quant. This one is trading pretty much bang in the midpoint of the 52-week range with a yield of 0.8%, and we can see a forward P around 41.5. Now, up 30% over the last year, over the last 10 years, another one that has significantly outperformed the S&P, up around 829%, and also 3 for 3 in terms of beating analyst targets, a 100% track record over the last year, and we can see some nice growth estimated over the next 3 to 4 quarters. Again, if they do hit that EPS estimate for 2025, the forward P will come down to a much more reasonable valuation of 26.08. Now, our valuation of ASML at $1,152, not dissimilar from Wall Street's 1173, where they're indicating here 35% upside over the next 12 months. Now, margin of safety then at 10% for ASML, a buy at 1036, at 20% around $922. And in today's episode, we can in fact see here that it is around a 25% MOS. So in conclusion, based on the estimates and judgments for ASML, we have a 25% MOS and 35% upside from Wall Street. As always, do give us your thoughts below. We then move on to Este Lauder, which is a double buy and interestingly a sell from Quant. This is trading right there towards its 52-week low. It does have a yield sitting above the 3% level, and the forward P does sit around 39. Now, this has been absolutely hammered down 45%, just over, in fact, over the last 12 months. But still, if you've been holding over the last 10 years, you would be up around 20%. Again, very poor over the period. And we do see all-time highs at the back end of 2021, the $366 mark. Now, in terms of how they've been, actually, again, very impressive. They have beaten analyst targets over the next 4 quarters, and they are estimating over the next 2 triple-digit growth to the EPS. Again, if they hit the 2025 estimates, what we can see here is the forward P coming back down to a very reasonable 21.64, but ultimately it will depend on whether or not you believe these companies over the longer term will be able to turn things around. Now, our intrinsic value of $138, not too far off Wall Street's 134. They see 46% upside over the next year. And when we run it through the margin of safety, there is a massive amount. Just 10% would be a buy up to $125. At 20% around 111, at the 30% level around 97, and at the 35% mark around 90. So sitting somewhere between a 30 to 35% MOS for Este Lauder company in today's episode. We then move on to STM Microelectronics with another double buy and a sell from Quant. Again, very similar to EL, trading right there at its 52-week low, with the yield sitting just above the 1% mark, forward P around 17.5, and hammered down 38% over the last year. When we take a look over the last 10, however, they have significantly outperformed the S&P, up 270%. Now, in terms of their performance, this one has been a little bit of a hit and miss. Over the last 4 quarters, 1 miss, so a 75% track record, but the next 3 or 4 are anticipating earnings per share to be a decrease year on year, and if they do hit that 2025 December EPS estimate, forward P does come down to around 12.3. Now, our intrinsic value at $48, pretty much spot on to Wall Street, and they see 60% upside over the next year, with our margin of safety at 10%, indicating a buy at $43, at 20% around 38, at 30% around 34, and in today's episode, we are seeing at least a 35% margin of safety for STM, with some significant upside from Wall Street. Again, will depend whether or not you do believe these companies are high quality and will continue to be seen over the long term. But do give us your thoughts, and if there are any you want a deeper dive on, if we haven't done in the more recent period, we can definitely take a look. Continue on, we have Marvel Technology with a strong buy from Wall Street, a buy from Seek Alpha, and a hold from Quant. This one trades in the mid to lower end of the 52-week range, one of the lower yields at 0.4%, forward P around 43, and over the last year up 7%, over the last 10 years. Again, another one that has significantly outperformed the S&P, up 359%, with all-time highs sitting around the $90 mark, December 2021. Now, when we do take a look back, not too bad. They were in line over the more recent 2 quarters, and we can see Q2 and Q3 of 2024, they did beat. Now, they are anticipating some very mixed earnings over the next 4 quarters, but do bear in mind for the semiconductor companies that we have reviewed today, they are all in a cyclical industry. Again, January 2026, that forward PE will come all the way down to around 25.12. Now, in terms of the valuation, our intrinsic value $90, Wall Street 92 with upside of 44%. And when we take a look at an MOS, well, 10% a buy at $81, at the 20% mark a buy at 72, at the 30% mark not quite there just yet, so you are getting somewhere between 25 to 30% for Marvell Technology, with, as we said, Wall Street indicating this as a very strong buy. We then move on to the penultimate one, Global Payments, with another double buy and that sell from Quant, trading in the mid to lower end of the 52-week range. Bang on 1% yield right now if you are executing on this company. Forward PE just below 9, and over the last 12 months down around 18%. Over the last 10 years, you would have still outperformed the S&P, up 186%, with all-time highs sitting around the $217 mark 3 years ago. In terms of their earnings, well, they did in fact beat out of the last 4 quarters, so 100% track record, and expecting double-digit growth to the EPS over the next 4, and we can see December 2025 forward PE coming down to around 7.64. Now, Wall Street do see 39% upside, their target 143. Our intrinsic value marginally higher at 147. This may be one of the largest margins of safety today. A buy at 10%, $132. For the 20% level mark, 118. For the 30% mark, pretty much bang on the current trading price. So if you do believe in Global Payments, you are looking at a 30% MOS with 39% upside over the next year. As always, do give us your thoughts below. We then move on to SLB, where we get another strong buy from Wall Street, a buy from Seeking Alpha, and a hold from Quant. This is trading right there at its 52-week low, a yield of 2.51% and forward P of 12.5. Over the last year, pretty poor performance, negative 26%. Over the last 10 years as well, not the greatest, negative 60% in a pretty much downward trend over the last 10 years. And when we look again, pretty decent performance. 3 of the last 4 they have beat, with 1 of them being in line, and nice double-digit growth anticipated over the next 4 quarters to that EPS, with their December 2025 estimate bringing the forward PE to around 10.6. Now, straight away with the valuation, we can see a very large upside of 50%. At the $66 mark, our intrinsic value is actually lower at 56. And when we do take a look at the margin of safety, well, at 10%, a buy at $51, at 15% around 48, and in today's episode, you are getting at least a 20% MOS up to $45. Now, as always, do let us know your thoughts in the comments below, whether you are adding to any of these, maybe they're now on your watch list, or for whatever reason you don't believe in the longevity and they aren't any that you do consider for your portfolio. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter by clicking on the pinned comment below, and also joining the Patreon below if you do want to talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.